Hello everyone and welcome to our yet another discussion, and in this lecture video I'm going to take you through the preparation of a cash flow statement using our very nice question here, which I've uploaded on your student account, and I do believe you have read through. So this is BERAKO Uganda Limited, and we are given information regarding the statement of profit or loss and other comprehensive income, and also the statement of financial position. So we are going to make use of information in the statement of profit or loss and the statement of financial position to look at the cash flow statement of our enterprise. But of course, I should also mention that the additional information is very important in helping us arrive at the right solution to this question. So I'm going to make use of my Excel sheet here. And as we have been doing it before, for all other statements, we begin by giving our cash flow statement a title, BERAKO Uganda Limited, and that is our statement of cash flows for the year ended 31st of December 2014. So all the shillings will be in thousands, and of course we have to reserve a column for the notes. What I should mention here that is very important is that we need to also reserve the last column for the net cash flows from operating activities, net cash flows from investing activities, and net cash flows from financing activities. Please members, do not use this last column for any other additions. So I'm going to entirely follow the format, and I'm not going to change a thing. I'm going to follow this very nice format here for the indirect method. So as you can see on our format, we begin by recognizing the cash flows from operating activities. Begin by recognizing the cash flows from operating activities, and that's what I'm going to do. I'll begin by recognizing the cash flows from operating activities right there. Next, I'll pick the operating profit or loss before interest and tax. Okay, the operating profit or loss before interest and tax, and exactly that is what I have here, operating profit or loss before interest and tax. Now this one, I need to determine it in note number 1. Why? Because the profit given to me in the question, if you look at our question here, the profit given to me is profit before tax. So I need it before interest and tax. Of course, I'm focusing on 2014 because 2013 is just a comparative, and the profit will ideally be attributed to the year 2014. So in note number 1, the notes I've tried to put them alongside here. Okay, so we shall have our shillings in 1,000, and of course my note number 1 is capturing the profit before interest and tax. So the profit before tax, as you can see in our question, is 204. So I have to add back the interest expense, which is given when you read the note. When you read the note, you find that our interest expense, let me just take you there. We are told that the interest expense in additional information number 3 is 1,125,000. So that's what I'm going to take to my Excel sheet here, 1,125,000. And of course we shall less the interest income, okay, because that one ideally would reduce on our interest expense. So the interest income is given in note number 3 as well. That is the 500 million right there. So I'm going to deduct that 500 million, and at the end of the day I'll get the profit before interest and tax amounting to 204 million, 204,625. So in my statement of cash flows, my operating profit before interest and tax is going to be the 204,625. And as I've mentioned, we proceed to make adjustments for non-cash items such as depreciation, very typical, depreciation. And of course, depreciation is not easily given in our question like all other questions have been, but no worries, we can still compute our depreciation. So between you and me, you know that depreciation is really part of the accumulated depreciation account. So if I make reconciliations for the opening and closing balances for accumulated depreciation, I should be able to get the depreciation charge as per my note number 2. So the shillings are in thousands. Accumulated depreciation has an opening credit balance, and when you look at our question, that is the 95. Then we have the depreciation that we are going to balance off. It's going to be our balancing figure. Then we are given that there was a disposal. When you read note number, let me just get to the note. When you read note number 2, there was a disposal of non-current assets, and the accumulated depreciation, okay, the accumulated depreciation on that asset was 38 million. So I have to bring in the 38 million right here, okay. And then of course I have the balance carried forward, it's closing debit balance of 107. So I'll balance off the T account from the side, from the debit side, sorry, and then I'll be moving towards the credit side. So if that's the balancing figure, then what is our depreciation? So our depreciation, my computations are giving me the 505, okay, 505, and that is exactly what I'm going to bring here as our depreciation non-cash item. Next, we move to the disposal. Of course, there was a disposal also, as you can see in our note number 2. Okay, in our note number 2, we have a disposal, and of course, from the generally accepted accounting principles, we are supposed to determine a gain or loss on disposal. So this one is another non-cash item that needs to be included in our cash flow statement. So if I take you back to my computation schedule, you see that I managed to compute that, and that gave us a loss on disposal. So in note number 3, I will demonstrate, okay, how that loss comes about. So my note, I'll bring in my note number 3 right here, and of course shillings are in thousands. Now, to compute a gain or loss on disposal, we begin by recognizing the proceeds from disposal. According to our question, in note number 2, we are told that during the year 31st of December 2014, non-current assets originally costing 55 million were disposed of for 10 million. So the 10 million are the proceeds that we received on disposal, and we are told that the accumulated depreciation on the asset disposed of on the 31st of December 2013 was 38 million. We are further told that it is the company's policy to charge full depreciation in the year of acquisition and none in the year of disposal. So as we have seen in the note, the proceeds from disposal amounted to 10 million. So we less the net book value. To get the net book value, we have to get the cost, which is indicated in note number 2, minus the accumulated depreciation, again indicated in the same note. So the cost we are told is 55 million, and the accumulated depreciation on the item disposed of is 38 million. So the difference gives us a figure of 17 million. At the end of the day, if you compare the 10 million that we got in proceeds and the net book value or the carrying amount of the asset, you see that we actually made a loss on disposal of 7 million shillings. So when it comes to the cash flow statement, the 7 million shillings is supposed to be recognized according to when it comes to the cash flow statement, the 7 million shillings is supposed to be added back. Okay, supposed to be added back because this was initially deducted as an expenditure according to the rules of accounting. We're supposed to recognize this loss on disposal, yet it is not a cash item. So by adding it back, I try to season out that deduction, which is a non-cash item. So all in all, those are the items, or those are the non-cash items that we are supposed to come to our cash flow statement. And following our format, after we have made adjustments for non-cash items, we now move into the working capital. We now move into the working capital items. So as per our format, we need to look under the working capital items. We need to consider inventories, movement in inventories. We consider movement in payables, accruals, movement in accounts receivables, and prepayments. So we shall first of all look at the inventories in our question. So going to the statement of financial position under the current assets, as you can see, the inventories moved from 20 million in 2013 to 90 million. So I would say there was an increase in inventories. Next, we have an increase in receivables from 86 million in 2013 to 167,600 million in 2014. The prepaid expenses also increased from 3 million to 4 million. When you go to the current liabilities, we have the payables, which moved from 60 million to 100 million. Accruals moved from 8 million to 10 million. So I can see there's an increase in most of the working capital items. So of course, increase in inventories, as you can see, is in brackets, it's an outflow, and the explanation given under the standard is that when your inventories increase, you have spent money to purchase those inventories. So that is an outflow. That's why our inventories are in brackets here. Increase in receivables. Increase in receivables is increase in receivables is another outflow, as you can see in brackets. It is in brackets. So the meaning of that is that people have taken away your goods and are not paying you, so resources have moved out. Okay, so that's why it is an outflow. Then increase in payables is an inflow. It's not in brackets. Okay, it's not in brackets here. The meaning of that is that you have acquired resources from other people. You have purchased from other people on credit, and therefore you have retained the monies, have retained the money to you. So that is an inflow. Then increase in prepayments is an outflow, and of course the meaning of that is that you have continued to prepay your expenses, and thus money keeps on moving out. So all in all, we can say that the items that are in the same class, like the current assets, as you have seen, inventories, receivables, and prepayments, okay, behave the same way. If there's an increase, it means an outflow, money has moved out. And for the items or elements in the class of current liabilities, if there is an increase, it means that money has moved out. If the accruals have increased, money has come in, we have an inflow. So moving to our cash flow statement, as we have just observed, beginning with the inventories, as we have mentioned, our inventories, you can still calculate the difference on the face of the cash flow statement. That is okay, you get the marks. So we have 90 minus 20, an outflow of 70 million. And again, we have seen an increase in receivables, 167.6 million minus 86, an outflow of 81.6 million. Then we have an increase in payables, 100 million minus 60 million, an inflow of 40 million right there. And then we have increase in prepayments. Definitely that is an outflow of 1 million there. Finally, we have the accruals, which jumped from 8 million to 10 million in 2014, and that is an inflow of 2 million. So these are the working capital items that you were supposed to consider for our cash flow statement. And when we get the total, that gives us a total of 151,525,000. Now when I'm totaling, I total from the operating profit before interest and tax, and the figure that you get is, as we have seen in this format, is the cash flow from operations. Cash flows from operations. Now, because interest and tax are real factors of the economy, as I mentioned in our previous discussion, these need to be brought into the cash flow statement. Now, before you handle these two, you need to first of all ascertain whether the figure given to you in the statement of profit or loss was actually the cash that was paid. The figure that you're given in profit or loss was actually the cash that was paid. So for the case of interest paid, I need to go to the statement of financial position and I check in my current liabilities. In my current liabilities, as you can see, I have an item known as interest payable. I have an item known as interest payable. So what does this one communicate to me? This one tells me that interest is not maintained on cash basis. So the firm will accrue interest when it falls due. This is a signal that the firm may not have enough cash for it to clear interest as it falls due. So the figure given to us, the interest expense, I think we saw this in note number 3. We saw an interest expense of 1.125. So it means that this 1,125,000 interest expense for the year is not actually the cash that was paid, because of the fact that there is a liability outstanding. So that tells me that I need to reconcile the opening and closing balances together with the charge for the year to determine exactly how much interest was paid. Similarly, for taxation, I need to determine whether the taxes are maintained on accruals basis. However, I should mention that by its nature, taxation is paid in arrears. Taxation is paid in arrears, and you will be in position to have this item in all the statements of financial position for most companies, because taxes are paid in arrears. So the implication of this is that the taxation given to us for 2014 of 52 million is not the actual cash that moved out towards clearance of the tax charge. Now, I need to again, as I've mentioned, I need to again show the examiner in note number 5 how I have arrived at the taxation paid. So those two notes follow here. I'll share with you my note number 4 for the interest paid. Okay, the interest paid, as I've mentioned, because it is a liability and because it is accrued, I need to reconcile between the opening and then I have the closing balance, then I have the charge for the year, and then the balancing figure is going to be the figure I'm going to take to the cash flow statement. So according to the balance sheet, if you look at the question, the opening balance for interest payable is 1,400, the closing balance is 800, the profit and loss as given in the note number 3 is 1,125,000. So I will have to balance off from the credit side. Okay, I will have to balance off from the credit side. I have to balance off from the credit side. So when I total the figures on the credit of the T account, it gives me a figure of 2,525,000, which is exactly the figure that I'll bring right here. So at the end of the day, you can check the balancing figure comes to 1,725,000. Similarly, for taxation paid, I will do the same thing. Okay, these ones are almost in the same family. they are both liabilities. So what I'll do to get the taxation paid in cash, I need to reconcile between the opening balance of the taxation in the statement of financial position, closing balance in the statement of financial position, the charge for the year given to me, okay, and then the balancing figure is going to be the figure that I'm going to take the statement of cash flows, which is ideally how much cash that moved towards payment of taxes in 2014. So when you revisit our question, you see that the opening balance for taxation is 32 million, closing balance is 52 million. In the profit and loss account, we are given a figure of 52 million, meaning that I have to balance off from the side of the credit, which is complete, the credit side, thus giving me the balancing figure as 32 million. I would say that the company decided to pay the tax charge for the what? The tax charge for the year, because that is the 52 million. But of course, that may not be the case. Now, the two figures, the two balancing figures for interest payable and of course the taxation that we have paid are going to be taken to our cash flow statement. So I'm going to take those figures to the cash flow statement. These two figures that I put in blue are the ones I'm going to take to the cash flow statement. So to the cash flow statement, I have note number 4, that is my 1,725,000, and then the taxation paid as per note number 5 comes to 32 million shillings. So these ones, I picked them from the T account. So at the end of the day, we shall have to determine the net cash flows from operating activities, which is an addition of the 151 cash flow from operations plus the minus the interest paid minus the taxation paid, and at the end of the day, the figure that I get, I take it to the last column, as I indicated that the last column is reserved for the totals, okay, the totals for each of the 3 parts of the cash flow statement. So all in all, that is our net cash flow from operating activities. Next, I'll move to the investing activities, and again I'll follow the format. We have seen from the format that the investing activities include purchase of non-current assets, okay, so I'll need a note for that. Then I have proceeds from disposal. This one is quite easy, I don't need a note because we are told that when the disposal took place, we received proceeds of 10 million. Then we have interest income from the investments, and I'm going to have a note for that. Okay, I'll reconcile the opening and closing balances of the interest receivables account, which is given in the statement of financial position, this one right here. Okay, the figures are going to come from there, and then the figures for the non-current assets to help me determine how much cash we paid for the purchase are going to come from that item right there. So going to my notes in the Excel sheet that I'm using here, just below I have the purchase of non-current assets, and of course I'm going to use the T account for the non-current assets. Okay, now this format that I'm going to present here is going to be useful as you continue to work out the cash flow, as you continue to prepare your cash flow statements. So for the non-current assets, the opening balance, if you check the question, the balance brought forward is 176, and then we had disposals of 55 million. Remember, this is the cost. Then we have the balance carried forward, which is 239, leaving us with a balancing figure, which is the money that we paid to purchase our non-current assets, as 118 million. So all in all, the subtotals, or the total the balances for each of the two sides of the T account come to 294 million. Similarly, as I've mentioned, we have the interest received, how much interest we received, So I have the interest receivables account, and I'm going to reconcile between the opening and the closing balances. So the opening balance, as you can see, our question is 300 million. Then of course the closing balance is given as 400 million right there. Now we are told that there was some interest income that we earned of 500 million. Okay, if you look at note number 3, you'll see that 500 million, meaning that we received money associated with the interest receivable as the balancing figure. And of course, what's going to guide me is the debit side, because this one is complete. Okay, so I balance off from the credit side with the cash received. So the cash we received on interest is 400 million. So I'm going to take this 400 million to the cash flow statement and investing activities, and the 118 million for the acquisition of non-current assets. So those two are going to come to my cash flow statement right here. Okay, so I'm going to have my figures, right here. Purchase of non-current assets, that is the 118 million, money moving out, cash outflow. Then interest income, that is money coming in, cash inflow. So that one I don't put in brackets. So at the end of the day, we shall have the net cash flows from investing activities, which come to 107,600 million. All right. Next, we move to the last part of the cash flow statement, which are the cash flows from financing activities. And now this one, I'm going to give you a very, very special skill for handling financing activities. Now, when it comes to financing activities, the first thing you should ask yourself is, where do we get money? If you are financing our enterprise, where does the money come from? So usually money will come from equity. Okay, equity, when you issue more shares, okay, you get money to finance your company. And then money will also come from long-term liabilities. Leave alone the short-term liabilities, but the long-term liabilities, where you of course apply for a loan from a financial institution, and then you are given money to finance your company. So you're going to concentrate on those two parts of the statement of financial position to be able to exhaust the cash flows from financing activities. And then again to confirm this, you can look at the format given under the standard. As you can see, we have proceeds from issue of shares, that's money coming from issue of shares, proceeds from issue of debentures, acquisition of long-term debt, dividends paid, redemption of debentures, repayment of loans. So when you pay the loan, money moves out. When you settle your debentures, money moves out. That's why these are in brackets. And when you pay a dividend, money still moves out. Now money will come in if we issue more shares, if people buy shares. And of course, when people buy shares, they have to give us money. They don't have to bargain that let me pay tomorrow or the other day. This is done on cash basis. That's the beauty with these. These are all cash basis. If you borrow money from the bank, money is going to come in cash, not in a promissory note. So I'm going to, of course, consider that when I'm working out the financing activities for my cash flow statement. So we are going to move line by line, just looking at the movement in equity and the movement in the long-term liabilities. Now, to start with the ordinary share capital, you see that there was no movement between 2013 and 2014. So I don't expect money to have come from issue of shares. Similarly, with the preference shares, there is no movement between 2013 and 2014. So no money, no cash was received from issue of ordinary shares and issue of preference shares. Now, when you move down to the other item under equity, retained earnings, you see that there is an increase in retained earnings. Okay, there is an increase in retained earnings. Now the question is, what would cause an increase in retained earnings? One, retained earnings would ideally increase if we have made a profit. So you need to first of all check the difference between the opening balance, which is the balance from 2013, and the closing balance, which is the balance for 2014, and check the difference here. Okay, so when I get my calculator, 101 minus 30, that gives me a figure of 71 million. Okay, that gives me a figure of 71 million. Now I need to check and see whether the profit that we made is 71 million. Now when you see the profit that we made for 2014, we made a profit, of course you consider the profit after tax. We made a profit of 152 million. And of course, what does this one tell me? This tells me that the difference is not actually the profit for the year, because I would expect a 152 million, but I'm seeing 71 million. So it means that we should have paid a dividend. And that's what. Now we are going to have a T account to look at the dividend that was paid, because that one ate away our retained earnings. So I've given a full account for the movement in equity and the impact on our cash flow statement. Next, I'll move to the long-term liabilities, and of course here we have the 15% loan. Now as you can see, our loan has moved from 6 million to 7.5 million. So what does this one tell me? This tells me that we received more money from issue of loan, or I would say we acquired additional 15% loan. We acquired an additional loan. So the difference here is 1,500, and that should be the proceeds that we received from issue, from acquisition of the additional loan. So these are the things I'm going to bring right here. Okay, but of course the proceeds we don't need a note for it. We already know that's 1,500. So what I need to work on are the dividends. Dividends paid. So that can be my note number 8. Okay, note number 8. This is the dividend paid. Okay, dividend paid. So this is going to be the retained earnings. I'm going to reconcile the opening and closing balances of the retained earnings account. And of course you all know the behavior of retained earnings. The opening balance will come here, the balance brought forward for retained earnings. Okay, as you have seen, the balance coming from 2013. When you look at our question here on retained earnings, the balance is 30 million. Okay, so that's what I'm going to bring here. That's what I'm going to place right here, 30 million. And then the closing balance, the balance carried forward, is 101. Okay, then we bring in our profit or loss. We had a profit of 152 million. So at the end of the day, I'll balance this account off from the side, from the credit side, which is complete. So that is 182 million. Okay, was 182 million. This is 182 million. So the difference should be the dividend. The difference should be the dividend paid. Okay, that's the balancing figure. That is our balancing figure. I'll abbreviate it like that. So our balancing figure is definitely 182 million, the total, minus 101. which gives us 81 million. So we paid a dividend of 81 million. Let me put it in blue, like I've been doing for all the others. And that 181 million is what I'm going to take to my cash flow statement right here. Okay, I'm going to put my 81 million, and that's money moving out. So I've given the full account for the cash flows from financing activities, and at the end of the day, I'm going to get the total, the net cash flow from financing activities, and that comes to an outflow of 79,500,000. So as you can observe, the last column has been reserved for the totals, okay, those ones, okay, the operating, investing, and financing activities. That is how we should do it in the examination, and don't mess up with this last column. So at the end of the day, I will add the totals for the net cash flows from the three parts of the cash flow statement, and of course I've already determined that total, which is 63 million. It's a negative, so it will be a decrease in cash and cash equivalent. So the implication of this is that whatever we did in the financial year led to a decrease in our cash levels. However, we had some cash at the beginning of the financial year, which is 71 million, which is 7,100,000. As you can see, the money that we had at the beginning of the year, okay, this is our 7,100,000. And as you can see, at the end of the financial year, we don't have any positive cash. Instead, we have a bank overdraft of 62. So our cash flow should balance at 62,200,000. So I know you're excited to see whether we are balancing at that. Now, of course, this is for learning purposes. If you have an overdraft at the, of course, as an opening balance, you also need to include it here. You less it from all these figures, and at the end of the day, you have our closing cash and cash equivalents. So as you can see, we are totally right and accurate. Our cash flow statement has balanced at the closing balance of 62,200,000, which we have as our overdraft right here. So congratulations, we have managed to complete the preparation of a cash flow statement. And if you have any questions, please go to the account, your student account, and send me that question or an inquiry, or you can make use of the WhatsApp numbers on your screens right now. Contact me, and I'll be very, very happy and glad to assist you and give you support when it comes to the cash flow statement. So for now, I wish you all the best, and please try out the assignment that I've included and uploaded onto your student account.